Alright, so our class today will be about statement of financial position. SFP in full means statement of financial position. So a statement of financial position was formerly called balance sheet. Balance sheet. But as we may have known, this word balance sheet is not really meaningful. So it was changed to statement of financial position because balance sheet, when somebody tells you you're preparing a balance sheet, then a layman may ask, well, what is a balance sheet? What is balancing? But this one shows the document is a statement of financial position. So it's more meaningful and useful to the users of financial information. Now, statement of financial position, as the name suggests, shows the position. So this one shows the financial position. Shows financial position. So what do we mean by financial position? So by financial position, we talk about the worth of the business, specifically the net worth. So this one reveals the net worth of the business. So the objective or the purpose of this financial report is that it shows financial position and specifically the net worth of the business. Now if you look at the accounting equation is like this: asset is equal to capital plus owner's equity. And I mean asset is equal to owner's equity plus liability. So if you look at this, owner's equity, this capital is the net worth. Asset is the worth, but the worth, there may be some claims to the worth. So when you list those claims, so it could be something like this: capital or asset minus liability is equal to capital. I think that is algebra. So asset minus liability is equal to capital. So which means if you want to know our net worth, we take our asset, we less our liability. So if a business starts operating now with 200,000, then that is the net worth of the business as at that time. But after 1 year it makes a profit of 50,000, then you add it to the initial capital or initial owner's equity to get the current net worth of the business. So basically, we would want to know, every business would want to know its net worth, and that is why we prepare statement of financial position. Now, statement of financial position comes after the preparation of the income statement, because the income statement will inject either profit or loss into capital. Profit or loss. So if there's a loss, it will reduce capital. If there's a profit, it will increase capital. So that's why you have to prepare income statement before preparing the statement of financial position. Because the statement of financial position is now the ultimate representation of the accounting equation. So in the statement of financial position, all the elements of the accounting equation are presented. Now you see asset, the capital, and you will see also liabilities in the statement of financial position. So what is apart from our financial position with respect to our net worth, what is our financial position with respect to our asset? What is our financial position with respect to our liabilities? And what is our financial position with respect to our owner's equity? So, statement of financial position is the ultimate representation of the accounting equation. Okay. So all these are presented in the statement of financial position. Now, after this, I'll just show you the format, and then we will jump into the detail. A simple example, and that will be all. Now, what happens here is that like I said, we will have this representation, so keep it in your mind. So what will happen here is that we will have something like let me call this Nelly business. Then I have statement of financial position. So this one is in brief, but don't use this. Use the full name. Then as at. So statement of financial position is always as at a particular time. So as at. So we will have something like fixed assets, fixed or non-current assets. They're sometimes called fixed, sometimes called non-current assets. So we will have that one here. Then we will have current assets. Current assets. We'll have it here. Then we'll have current liabilities. Current liabilities. We'll have it here. We will less. Then this figure will come here. Then this one now will be, it's called net assets. I'll explain why it's called net assets. So this is called net assets. Then you will have, so this one will be a double line. Then you will have long-term non-current liabilities, or the funders of the business. So let me just write here long-term liability. Long-term liability. We'll have it here. Then you have equity section. Equity, where you will have equity, you will have capital, let me put it here for now, and profit or loss for the year. So this is profit or loss for the year, which you put it here. So this one, so equity is this one, and then you will have a double line. So this figure x1 and x1 should balance. So I don't know that it's legible, but I hope you can have a glimpse of it. So this is the title of the report. Then fixed asset, then current assets less current liabilities. Then you add this here, then you have net assets. Why it's called net assets is that because your current assets, are offset by your current liabilities, so that you have your net assets there. Now you would also have the other side where you will have long-term liabilities and then equity. So somebody may be asking, how is this a representation of this? Because the former way was just to list assets in a T format, something like this. Let me just explain to you in a moment. So balance sheet used to be like this. Balance sheet, it will be assets here, list, then here land, what, then this side liabilities, you list, then here let me say payables, and then you have capital here. Yes, so this one would show you very clearly how asset is equal to capital plus liabilities. But in this other format, it is not very clear, but it is still the same. Though it is a little winded, but it is still the same thing. Because if you look at it, asset is equal to long-term assets and short-term assets. So this is long-term and current assets, and this is capital, and this is long-term liabilities and current liabilities. So if you break up the, if you broaden the equation, the algebraic equation, asset will be something like long-term assets. So let me just say assets long-term plus assets current is equal to capital plus liabilities long-term plus liabilities current. Yeah, so you can rearrange this so that you will have assets long-term plus assets current minus liabilities current is equal to liabilities long-term plus capital. Yes, so this is what the current format shows. Assets long-term is fixed assets plus assets current less liabilities current, and then this figure is equal to long-term liabilities plus equity, which is capital. So it is still assets is equal to capital plus liabilities, but rearranged in a way that it should at a glance be meaningful to the user of financial information, so that if somebody wants to know what is your what is your liquidity, you can look at this straight away. Current assets less current liabilities can get your liquidity at a glance. If you want to know your net assets, because users are just not concerned with your assets, but with your net assets, because your assets can still have obligations to be met, and then equity at a glance, and then long-term liabilities at a glance. So this rearrangement, this format is also meant to help users in appreciating some information just at a glance. So let me give you an example now so that we can finish this up. So we have this daily business. So here, let me remove this title now so that I can have enough space. So here I have Nelly, my Nelly business. I have trial balance as at 31st January 20. So I have capital, let me say 100,000. I have sales or revenue 200,000. I have purchases, let me say 120,000. This is debit, this is credit. Then I have, let me say, receivables, let me say 80,000. And I have rent, let me say rent here 20,000. And I have let me say payables 10,000. And I have bank. So these are simple one. Bank is the difference here. So let me get this as 310,000, and this is also 310,000. So bank will be, this is 200, 220. So bank should be 90,000, if I'm not wrong. 90,000. So bank is 90,000. So this is 120 plus 80, 200, 220 plus 90, 310. This is 100, 200 plus 10 is 310. Now you are required to prepare a statement of financial position. But as we told you in earlier, we said you can't prepare a statement of financial position before preparing an income statement. So first you will have to prepare an income statement. And how will your income statement look like? I just want to be brief because I don't have enough time now for this. You have your sales. You have your sales 200,000. Let me say 200. Then you have cost of sales. Cost of sales where I have opening stock 0. Purchases were 120,000. So this is cost of goods available for sale 120, then closing stock. So let me say that additional info, 10% of purchases were not sold. 10% of purchases were not resold. Were not resold. Were not resold. So what will happen here is that this additional info, 10% of purchases were not resold, which means they were still in stock. So 10% of purchases is 12,000 because 10 times 120,000 is 12,000. So closing stock is 12,000. So this, if I list 12,000, so this should be 120 minus 12. Is it 108,000? So this is 108,000. So this cost of sales is 108. Then I will have here 92,000. 200 minus 108 is 92,000. And this is the gross profit. And then I will have other expenses here where I will have, sales, purchases, rent. I will have rent of 20,000. So I will have rent of 20,000. So this one, my net income will be 72,000. So my net income is 72,000. So now I can prepare statement of financial position because I've already prepared an income statement. So this net income will go to the statement of financial position in the side of equity, in the side of capital. So let us start now to prepare statement of financial position. So let me wrap this. Trial balance. Wow, why am I wrapping it? And I need this information. Okay, let me see. Capital is 100,000, so I think I should just note this information somewhere. Capital 100,000, and then purchases is there. Then receivables is 80,000. Receivable is 80,000, and then I have rent of 20,000, and then I have this 10,000 is payables. Payable is 10,000. Is 10,000, and then I have bank was I think 90,000 because this was 310, this was 200, 220, bank was 90,000. Bank was 90,000. So bank 90. So this is information from the trial balance which I will use in the statement of financial position. So let me just do this. Statement of financial position. So this will be name business. Statement of financial position as at that. So I will start with fixed assets or non-current assets. So I will have here fixed assets. So my fixed assets will be actually I don't have any fixed assets, so it will be 0. If they were there, I would have listed them here. Then I put the total here. Okay, so my fixed assets are 0. Then I will have my current assets. My current assets. So fixed assets are assets that are expected to last in the business for more than one financial period. So things like land, vehicles, buildings, machinery. So those are fixed assets or non-current assets expected to last in the business for more than one financial period. Now, current assets are assets that are expected to last in the business for a period not exceeding 12 months. Yeah, 12 months, because a financial year is 12 months. So basically, current assets here we will have something like receivables. You would expect your receivables to pay you up within 1 year. Of course, in real life situations, we normally age receivables, which means there's some receivables you expect not to pay you within 1 year. So those ones would be reclassified as non-current assets. But for these purposes, let us just assume that all our receivables are, expected to pay us within 1 year. So our receivables will be 80. We'll have our bank, which is a current asset. Bank is current asset, so that is 90. And then that is all. So we have handled this, we have handled this. These are the real accounts that I was talking about. I said that real accounts go to the statement of financial position. Nominal accounts go to the income statement. So let us do some addition here. 80 plus 90 brings us 170. So this one will have 170. So our net current assets will be 0 plus 170, which is net current assets, which is 170. So we'll have a double line because it is expected to balance with the other section. And then we will have long-term liabilities. Long-term liabilities. This one will have something like debentures, 10-year loan, 3-year loan, or things like that. Long-term liabilities. In this case, they are 0 in our business. And then we will have equity. We will have equity. Now, equity, remember, we had something like capital, the initial capital. So equity is capital plus retained earnings. So our initial capital was 100,000, and then we add our net income for the period, which is there's something I'm messing up. Sorry, let me redo this. Let me redo this. I've seen that I've not affected payables. So current assets is 170,000. Then current liabilities. Sorry for that. Current liabilities should be, I have payables. So this is payables. This is payables, which is 10. Now, and again, there's something I missed here. In this income statement, there was closing stock. Now, this closing stock should go to the income statement as current assets. So we will have here, instead of 170, we will have stock first, or inventory. So this inventory of 12 should come here, so that we have 80 plus 90, which is 170, plus 12, which is 182,000. So this is 182,000. This 182,000 is when we have current liabilities, and we have payables. We have payables, we have payables of 10. So this payables of 10 now is, we less it. You know, current assets less current liabilities. Yeah. Then we have net current assets less current liabilities. It's 172,000. So this will be 172,000. So it will be here 172,000. So net assets will be, net assets are fixed assets plus net current assets. Net current assets are 172. So this net assets will be 0 plus 172, which is 172. Okay. Now we go to the other side of the equation, which is what the things that fund this. Sometimes you will get the word funded by, then the list long-term liabilities and equity, because these net assets are funded by, you know, the capital and the long-term liabilities. Okay, so the sources of funds for this is long-term liabilities. So we will have long-term liabilities, of which here we have 0. Here we have 0. Then we have equity. Equity here we'll have the initial capital, which was 100,000. So initial capital was 100,000, and then net income for this period was 72,000. So we get this from our income statement. So 100 plus 72 is 172,000. So we have here 172,000. So this one should balance with this one. So 0 long-term liabilities plus equity should be 172,000. So 0 plus 172 is 172,000. So this one balances with this one. So this is how we prepare a statement of financial position using the current format. So as you can see, if somebody at a glance, we can see net current assets are 172. Net assets are also 172 because we don't have fixed assets. Our equity is 172. So our net worth is actually 172,000. That is our net worth. So statement of financial position shows us our net worth. We may have only earned 72,000, but that one does not mean that our worth is 72,000. Yeah. So this one is financial performance, but this one is financial position. So that is how we prepare a statement of financial position, and also the purpose that it serves. I hope that you have understood something from this short lesson to your advantage. Thank you very much and have a good day.